Trading floors today look identical to casino floors. Lights blink, numbers tick, and people place bets on momentum. But true wealth building happens away from the noise, in a place of quiet calculation. The architect of this approach was Benjamin Graham. He built his wealth through a relentless mathematical discipline that transformed investing into a modern profession. After studying the wreckage of the 1929 crash, Graham realized that human psychology is the greatest threat to a portfolio. The panic of the crowd and the individual's urge to follow it destroys more wealth than any singular market collapse. Every time money changes hands, two distinct personalities are fighting. On one side is the speculator, driven by adrenaline and the hope of a quick payout. On the other side is the intelligent investor, operating on cold, hard facts. You cannot predict what the market will do tomorrow. To survive it, you have to master your own impulses today. Speculators buy electronic blips. They chase momentum, adding that someone else will pay a higher price later, right up until the bubble bursts. Graham defined a true investment as an operation that, through thorough analysis, guarantees the safety of your initial capital and provides an adequate return. This single 2D brick represents your capital, which buys a fractional ownership stake in a living, cash-producing business. That reality is easily forgotten on Wall Street, where the culture actively encourages treating shares like poker chips to be tossed around for a quick thrill. For an intelligent investor, the daily fluctuations of a share price mean nothing compared to the underlying value of the business they now own. To explain why prices swing so wildly, Graham created the allegory of Mr. Market. Imagine a partner who knocks on your door every single day, offering to buy your share of the business or sell you his. Mr. Market is manic-depressive. When euphoric, he sees nothing but blue skies and offers to buy your shares for absurdly high, unsustainable prices. But when the mood shifts, he panics. Blinded by irrational pessimism, he is willing to dump those exact same shares for pennies on the dollar. Mr. Market is there to serve you. You are under no obligation to trade with him, and his daily mood swings should never dictate your emotional state. Your greatest advantage is the absolute freedom to ignore the madness. You only answer the door when the math is in your favor. Most people assume that higher returns require higher risk. However, Graham split the world of investors not by the risks they took, but by the work they were willing to perform. The defensive investor follows a path of automation and high diversification. It requires strict emotional detachment to let the portfolio glide along its track. The enterprising investor actively hunts for undervalued companies. This path requires intense physical research and the intellectual stamina to hack through complicated balance sheets. Both the passive train and the active machete build wealth. The only way to fail is to choose a path that doesn't match your actual willingness to do the work. To survive, you need Graham's central concept, the margin of safety. Think of intrinsic value as a geometric citadel. Buying assets for significantly less than their worth creates a shield against future losses. While speculators are exposed, this buffer lets you withstand catastrophic shifts unharmed. Even historical geniuses have failed at this discipline. Sir Isaac Newton lost a fortune chasing speculative stock bubbles because he could calculate the motions of heavenly bodies, but not the madness of a crowd. The intelligent investor remains undisturbed by market noise. Protected by the math, you let the storm pass and allow compound interest to quietly work. Ultimately, financial success rests on your emotional discipline. Stop playing the casino's game. To start building your own financial fortress, hit the subscribe button and join us for the next breakdown.